Consumers showing resilience, credit card balances remaining flat, banks are actually tightening lending criteria. I'm Jeff Richardson, host of Credit Gauge Live. I'm joined as always by my colleagues Atif Mirza and Susan Fay. Susan, let's get right into it. It has been quite a volatile marketplace. Some good signs this month, but what are you seeing lenders do in response?
So what we found is that lenders have been reevaluating the tools that they use to manage credit risk. And in fact, in 2024, the use of VantageScore credit scores soared 55% compared to the prior year. What we saw in 2024 is that 42 billion VantageScore credit scores were used. And what this reflects is lenders, fintechs, and consumers are recognizing VantageScore as the industry leader with the most predictive and innovative scoring models.
Let's dig in then specifically into the average VantageScore. It dipped last month to 701. It's back up, right?
In March, the average VantageScore credit score increased by 1 point to 702 as a result of consumers exercising credit healthy behaviors. What we saw is month over month, credit delinquencies improved across all days past due categories. And in addition, the overall credit utilization rate also improved in March. So a combination of those two credit healthy behaviors led to the overall VantageScore credit score rising by 1 point.
So some stability out there, which is great news. Atif, I want to get a little deeper into that. Which categories are consumers showing some resilience? What's happening with balances and utilization?
Yeah, thank you, Jeff. So consumers showed resilience in how they're managing their credit in March. Overall balances, as Susan alluded to, they were essentially flat month over month. Specifically, credit card balances were also flat, only down $95 from February into March, $6,200 on average. What really stands out, Jeff, is that balance to loan ratios decline across all products, which tells us that consumers are paying down their balances more effectively.
So it sounds like consumers are doing relatively well. That's welcome news for the market. There are some areas where we're seeing some caution flags, right?
Yes, while consumers are credit healthy overall, there are some signs that we are watching closely. In March, credit originations declined across all products. And what we saw in credit delinquencies, they were stable in March compared to February. These are the signs that we are closely monitoring.
So this is good news for the marketplace. Thank you, Atif. Thank you, Susan. Up next, we'll have a special guest. Not only is he watching these trends closely, he's investing in them. We'll welcome Joe Lau, President and Chief Investment Officer of LordCap, one of Wall Street's most innovative institutional investors. Stick around for that. Welcome back to Credit Gauge Live, and I am thrilled to be joined by my good friend and one of the more outspoken and, in my mind, influential leaders in the asset-backed security market, Joe Lau. Joe is President and Chief Information Officer at LordCap, which is really one of the more innovative structured credit investment firms. And Joe is also Chairman of the Fixed Income Investor Network, which is a trade association whose members are hundreds of institutional investors that invest in asset-backed securities. And so, Joe, thank you for being with us today. And I have a question for you, and then maybe a follow-up that's a little bit more fundamental. But the first question I have for you is, when you think about the role that asset-backed securities play in consumer finance and the ability for consumers to get access to credit, how are investors feeling? What are their expectations and appetites for risk? And then what is it like from the issuer standpoint as well?
Absolutely. No, thank you, Jeff. I appreciate the opportunity to have this conversation with you. It's always good whenever we get a chance to sit down and talk about these things. First and foremost, the ABS market is key for consumer finance. If we look across different asset classes, there is a core need for financing and efficient financing through the ABS market. We're in a very interesting time. And if I was to have this conversation a month or two ago, I would tell you that general sentiment is very positive. Investors like what they're seeing out of the consumer, and there's an overall comfort with the marketplace. And that was pretty much what we saw at the Vegas conference at the end of February that you and I attended. Since then, of course, there's been a lot more volatility in the markets, and there's a significant question now about where the economy is going to go and what impact that's going to have on consumer spending and the credit of the individual consumer. So investors, I would say, are more cautious now than they had been, 3, 6, 12 months ago, but still interested in putting money to work. And there's a couple of important reasons for that. And I think the key is that even though we've seen delinquencies and defaults rising in consumer markets, in general, they're still within historical good bands, if I want to characterize it that way. So investors are not really seeing any danger signs immediately with the trajectory of where performance has been. That said, of course, the economy is going to be the driver of all these things, and there's a couple of elements that are still concerns. One of them, and it's a significant one, is the impact of consumer loan, student loan repayments, and when those really start to hit the data. We know people are having to make repayments, but we haven't seen a lot of performance quite yet. And after years of not having to pay on their government student loans, there is a big question about what impact delinquencies and defaults may have, and certainly what the substance of those is going to be. And that's of course going to impact a couple different things for investors. The first is the direct payments on other forms of debt. Do they have the cash in order to make those? But a secondary item, and one that matters, of course, for the issuers, is what does it do to their credit quality as they're having to make these payments? Often we find refinancing of consumer debt or taking on new consumer debt is extremely important for the performance of existing. So investors are watching that carefully. That said, we all have a great comfort with the structures that are in place, the rigor that goes into creating and maintaining an asset-backed transaction, and that continues even in negative credit cycles to show not only good investor performance, but also gives comfort that they can continue to invest in these types of structures. So from that perspective, certainly there's caution when we think of what that does to the issuer landscape. In any time of volatility, issuers are always told, have your deal ready to go, keep your investors in the loop and aware of what's going on. You really can't over communicate in these situations. And when there is some stability, then you're able to hit the market quickly. And certainly knowing that there are a lot of consumer issuers that want to come to market, it may mean some pretty busy times, but at least access to capital to continue to grow their businesses. The other piece I would throw in there, and it's increasingly important for consumer issuers and lenders, is the private debt market. There's a lot of capital in the private space. We all tend to move slower in that market and more deliberate. And for that reason, it doesn't necessarily open and close in the same way that the capital markets do.
So a lot of complexity going into the decision as to whether to issue these securities, and then of course all of those factors you described that go into the decision to purchase these securities. But let's just zoom out for a second. I'm not sure people quite understand the role that institutional investors play in the ability for a consumer, for example, to get an auto loan. Can you help us understand that?
Absolutely. So if we think about the asset-backed market, we're talking about 30 plus years of history where really the fundamentals are the ability to go out and source debt, whether it's from private lenders, banks, or institutional investors, based on the quality of the assets themselves. And our structures that we use are pretty tried and tested through the global financial crisis as well as other credit cycles, and really built around a number of things that give comfort and encourage our investors to get involved. The key ones really are that the transactions are structured in a way that includes various senior and subordinate bonds. So when an investor is looking to invest in high quality consumer assets, they also benefit from a level of subordination, which means that they are protected even if there's a deterioration in the portfolio. Additionally, all of these transactions are structured with excess spread, which is the difference between the amount of interest and other revenue that comes in and the cost of the securitization, an additional layer of support that is really the first line of defense against a bondholder losing any money. And it's very important to note that these are highly structured transactions with many triggers and other structural supports in them that ensure that if asset quality declines, the investors are going to be able to recoup their money faster. And when you put all of those various factors together, you get a very high quality structure that allows not only the lender to access the market and get very efficient funding, but also to give a good, solid backdrop for the investors that they're investing in reasonably safe securities, well-structured securities, and then they're compensated for that.
That is really important to understand sort of what's going on in the background. I'm not sure a lot of consumers really understand all of those moving parts that are happening while they go into the dealership and get a loan. Joe, thank you for being here. Thank you for those really interesting insights. And that is a wrap for this month's edition of Credit Gauge Live. Please go to our website to download the full analysis, and we will see you next month on the next edition of Credit Gauge Live.